Good morning, everybody. This is the live market open for March 8th, 2017. It's International Women's Day. Welcome, everybody, to the show. I'm Yochai, I'm a Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. And today we have quite a busy agenda. Of course, as usual, we'll talk about recent developments in markets, cover charts and levels, our technical session covering majors, minors, crosses, discussing the upcoming events with focus on two big events. We'll preview the ECB's meeting and preview the non-farm payrolls report on Friday. Our currency of the week is pound dollar, can't avoid Brexit. And then, of course, we'll talk about the week ahead. Your questions, as usual, as always, are more than welcome. So if you have any questions, you're welcome to ask, and if you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fxstreet-forex-live-video. Good morning, Ed. Good morning, everybody. So what's going on in markets? The main theme is that in 1 week from now, the Federal Reserve is going to raise rates. Okay, that wasn't expected a few weeks ago. Now it's basically baked in. We talked about it last week, we had many Fed officials talking about raising rates in March, giving us very, very heavy hints. And Janet Yellen, the chair of the Federal Reserve, topped it off on Friday evening by saying basically we'll raise rates unless a disaster happens. That means unless we have a terrible non-farm payrolls report or any other thing, they'll push it back. But everybody, including doves like Brainerd, like Dudley, talked about that. So that's the main thing. It pushed the dollar higher. We've seen a correction, but now the dollar is stronger once again. Another big theme in markets is the French elections. Okay, so we had a few developments early in the week. It does move the euro, and the race hasn't changed. It's basically extreme right Le Pen leading just with a bit against centrist, a young Emmanuel Macron, and in third place, center-right François Fillon, which doesn't have too much support from his own party due to various scandals, and he didn't quit. A member of his party, Alain Juppé, announced earlier this week that he will not run. Okay, so watch out for that. But for this week, the ECB is weighted. And another thing, oil prices are a bit stuck, but it's sort of more in the background. So just to return to the main theme, again, here are the main statements we heard last week. Really a chorus of Fed officials. It's rare to hear the Fed speaking in one voice, and also it's rare to hear the Fed going hawkish. So we had Dudley, number 3 at the Fed, saying there's a compelling case for raising rates. Then Williams said rates are abnormally low. Quite a strong statement. Brainerd, a permanent voter and yet another dove, said that we'll raise rates relatively soon. And Yellen said we'll raise rates bearing horrible data. Well, not using horrible, but saying, bearing any big surprise, negative surprise. Okay, so I think that only horrible wage growth, that means the non-farm payrolls report on released this Friday, March 10th, will stop the March 15th hike. Okay, a question here from Ed. With rates rising, how can they devalue the US dollar to make American exports cheaper? Yeah, that's a great question. And of course, there's a new president in town, Donald Trump. So, of course, if they raise rates, they push the dollar higher. And that is a problem for manufacturing. That also pushes inflation lower. But I guess they assume that the US economy is strong enough to sustain a rate hike, that exports are strong enough, that inflation is strong enough. And as my associate Leor Cohen from Trading Energy from Market Movers podcast said, that maybe they're taking the opportunity that financial markets, stock markets are looking good at the moment. That means that they're taking the opportunity to raise rates while everything is calm, sending a sign of confidence, even if the economic indicators are not exactly that great. And then they can, of course, cut rates later on, or push back further rate hikes later on when stock markets fall. Okay, I hope that answers the question. at the moment the dollar is of course stronger, but well, as far as I understand from Fed officials, they think they can, the economy can withstand a rate hike. Let's talk a bit about data. We had top tier figures. We had excellent figures from the United States regarding the future, the soft data. Both the ISM manufacturing PMI and the non-manufacturing PMI show very strong growth, 57.7, 57 as well. Inflation, the Fed's favorite inflation figures, the core PCE price index is stable at 1.7, very, very stable. Remember, it's higher than core inflation here in Europe. Jobless claims also look good, 223,000 new low. Factory orders, well, are up, but that's not a surprise. Trade balancing yesterday still shows a big trade deficit, not a big surprise, but it angers Donald Trump, especially his advisors. Yeah, and the comment here regarding the US economy by Ed, saying shopping malls all over are closing. Where's the recovery? Well, I think shopping malls are closing also due to the Amazonification of commerce, of shopping. But yeah, the big problem with the recovery in the United States so far is that, well, the economy is growing quite nicely. Well, not nicely, sorry. The economy is growing for a very, very long time, since the middle of 2009, okay? So it's a very, very long recovery. On the other hand, it's very slow, and of course, wages are rising very slowly. So you can see it as steady. If you want to talk positively, you can see it as frustrating, and slow if you want to talk negatively. So that's the problem with the current situation there. Elsewhere, here in the old continent, Eurozone inflation reached 2%. Well, note that in the ECB preview later on, which is the ECB's target, the holy grail of central banking. But core inflation is still stuck at 0.9, half of that in the United States. German unemployment continues, well, it's great. Another fall of 14,000. The unemployment rate is very low there. In the UK, we're seeing, if we're talking about future prospects of the UK economy, they're beginning to dampen with purchasing managers' indexes, forward-looking figures looking a bit weak. Okay. In Canada, GDP is up 0.3%, upwards revisions looking okay. Australian retail sales looking okay, and the RBA didn't change policy and doesn't intend to change it, so the Australian dollar is quite stable. We'll see that soon in the chart. Chinese trade balance released tonight showed a deficit. Sorry, first deficit in 3 years, but I think it's a bit due to the new year. Always figures are a bit distorted, and in the month of February, so I wouldn't get too excited from that. And final, Japanese GDP was not a surprise. Okay, so that's our data. All in all, the US dollar is stronger due to the Fed rate hike. Now let's see the stronger dollar on the charts. So this is our technical segment for major currency pairs, support and resistance levels as seen on March 8th. Okay, we'll start from the world's most popular currency pair, euro-dollar, currently at 105.60. Very frustrating trading, I would say. We're back to narrow range trading. So resistance here at 105.90. I would say weak resistance, but stronger resistance at 106.40. And if we zoom out just a bit, this is the hourly chart, we find further resistance there at 106.80, okay? Even further above, we have 107.60. Looking down, we have 105.20, quite a veteran line, not as strong as it used to be. And below that, we have 104.90, which was a double bottom, which was seen last week. Even lower, we have, well, far lower, 103.50. Moving to pound dollar, quite a fall there. This is our currency of the week. We'll talk about that later on, more in detail about the factors. But anyway, it's down 121.82. Some weak resistance here at 122. Further resistance, another round number 123. Another stepping stone on the way up is 123.45. And then the older line, which is not as strong as it used to be, 124.15 before 125.40. On the downside for pound dollar, we have 121.20 and the very round number of 120.00. dollar yen. Dollar yen, of course, moving up because of the dollar strength. Usually the best measure, the best barometer of dollar strength or weakness, currently just under 114, which I see now is weak resistance, stronger resistance there at the recent swing high of 114.75, and then it's followed closely, 115 used to be strong. To the downside, we have the round number of 113, followed by 112.50, which used to be the top range of, well, a narrow range there. 112 to the downside, and then 111.50. Relatively choppy trading in dollar yen. It's continued to dollar CAD. Dollar CAD is moving up, meeting here fierce resistance, as you can see. A strong resistance line there at 134.35. Just, well, below we have support there at 133.80. Quite choppy over there. Further support at 133, a round number, followed by 132.15, and further below 130.80 and 130.00. Looking up, strong resistance is at 136. Aussie dollar, well, quite a move to the downside right here, but if we zoom out, it's not such a big move. The Aussie dollar has been trading in relatively narrow ranges. So the previous range that the pair liked for quite some time was 76.10 to 77, with this pivotal line in the middle of 76.50. The wider range, if we look down, is 75.40. As you can see, it provided support in February and also now, and to the top side, 77.40. If we zoom out just a bit, you can see that ranges in Aussie dollar are quite narrow. At least the pair tends to stick to a range once it feels comfortable in this range. Okay, so currently 75.60. And Kiwi dollar, this is more like a trend than in our range trading. Much more excitement over here. So we fell here to support at 69.40, even dropped below that, but so far it's a false break. Anyway, resistance at 70.40. The round number of 70 does not play a role here in the Kiwi. The pair pierced through it quite easily. Further down, we have 68.80 and 68.20. Looking to the top side, lines that have become a bit obsolete because we've moved to the downside, 71.30 and 71.80. Strong resistance if we have a big move to the upside at 72.50. And we'll conclude the major pairs with the Swiss franc also moved to the upside because of the strength of the US dollar. 101.35, 103.30, which is out of this chart, is strong resistance. And well, we have some resistance here at 101.40, not as strong as it used to be. 100.80, 100.40 are sort of dense lines here. The round number of parity, it does play a role, very round number, and also served as support. Further below, we have 99 and 98.50. So this concludes our segment about major currency pairs. Before we move to the crosses, we have here comments by Ed. Ed says, I notice a stealth inflation in supermarkets. You get less for the same money. Manufacturers changing the weight and consumers don't realize the prices stay the same. Know that this is a few years back and it's a scam for data inflation. Yeah, it could be. I've also seen that in a few products. Yes, we have to, as consumers, we have to watch out for the changes in these products. We're always become a bit blind when manufacturers print out the word new. We see something new and we don't realize it's a smaller package. Anyway, Ed also says, I think your dollar will drive to 115, 120 area, or it will get hammered down by Super Mario. Yeah, we'll talk about the ECB soon, and perhaps, yeah. I see it. I don't see parity coming soon, not in the summer. Well, we'll talk about that in our segment about the ECB, about Super Mario hitting it lower. So this is our technical segment for the crosses as seen on March 8th. Lines of support and resistance will start from Euro Swiss, which moved a bit to the upside. Is the Swiss National Bank intervening here? Anyway, we're very nicely above the round number of 107, just above that, and you made a sharp move to the upside. 107.50 is the next line of resistance, followed by 108. If we look to the downside, we have 106.80 and even lower 106.35, which seems like a line in the sand for the S&B because look what a hard time the pair had to push lower. I think the Swiss National Bank would like to see Euro Swiss around 108, 110. Okay, but it's cannot be achieved quite easily. Moving to the Brexit pair, Euro Pound, currently at 86.70, so the pair moves higher. A lot of weakness in the pound, our currency of the week, where we focus on pound dollar. But anyway, here we have a resistance at 86.80, further resistance 87.70, and then 88.50. Looking down, we have 86.35, 85.70, and even lower, the round number of 85. If we have a big downfall here, I would note the round number of 84. So we have quite a trend to the upside here in the past few weeks. Euro yen, here are the lines to watch. 120.30 at the moment. The round number of 120 continues serving as support, working in early March, and here once again 120.50. It's a stepping stone on the way up, followed by 120.90, but strong resistance is at 121.35. To the downside, we have 119.30 and much stronger support at 118.20. Okay, I would say lots of range trading here, currently moving a bit to the downside, but well, I wouldn't say it's quite significant. Pound yen is a bit more interesting, 138.70, quite a downfall here. The weakness of the pound is reflected in this cross, very popular cross, the dragon. 138.50 is support, followed by 136 to the upside. 140 is not strong resistance, but 140.50 working as support in mid-February, and to the top side we have 143. Okay, and we'll, as usual, we'll add to our crosses a look at oil prices. This is WTI crude oil West Texas Intermediate. 52.70 is the current level. 54.50 remains a strong line of resistance, followed by 55.20. This line was not breached. An attempt to break higher failed. Support is at 52, followed by 49.50. Okay, so this concludes our segment for crosses. Before we move on, I see here more comments, questions from Albert. Good morning. Long time no see. I have established myself in the Swedish stock market, which seems very good for me. Do you have any thoughts about the Swedish market, my friend? Well, you're welcome, Albert. Thank you for the kind words. I must say I do not follow the Swedish stock market. I know that this interest rate in Sweden remains very low, and well, Sweden is a great country that has a great economy, but I have no idea about stocks. I have IKEA furniture at home like everybody else, but I'm not familiar, sorry. Let's continue with running across the upcoming events. We'll focus on the bigger events in our previews. So today we have the annual budget release from the United Kingdom. This could impact the pound, but Chancellor Philip Hammond is not such an exciting figure. Well, this may be a good thing, of course, because he doesn't make huge promises he cannot keep. More importantly, we have the ADP non-farm payrolls, private sector report from Automated Data Processing, a private firm, which is sort of a warm-up towards the non-farm payrolls on Friday. And we also have revised productivity and labor costs from the US and oil inventories. So I would say ADP, NFP is the highlight of today. But tomorrow we have the bigger events. Well, during the night we have Chinese CPI, and then we have the ECB rate decision. The decision is at 1:45. And Draghi's press conference, the more important part, is at 1:30. Join us, Mauricio Carrillo, I should say Valeria Bednarik, it's International Women's Day, Valeria Bednarik, Mauricio Carrillo, and myself in a live coverage of that event. At the same time, we also have the US jobless claims, as usual, every Thursday. And for Friday, the big event, of course, is the non-farm payrolls. This should be in bold, right? And before that, well, industrial output and trade balance from the UK. And for those trading the Canadian dollar, it's going to be a messy afternoon. The US NFP together with the Canadian jobs report at exactly the same time. We'll have a preview of the NFP soon. Okay, before we move to our next segment, I see here more comments. Albert says, no problem about not knowing about the Swedish stock market. Thank you for the kind words. Albert says, you have a good analytical mind. Just wanted to ask. Anyway, thanks. And Jax, good morning, Jax. Is there a grumbling in France to leave the Eurozone? Well, extreme right candidate Marine Le Pen wants to hold a referendum about Frexit, about France leaving the Eurozone. I would say that if she gets elected, just the thought that France could one day leave the Eurozone could spell a big disaster. France, there's no Euro without France. France is the core of the core. So there is talk about that. Currently, in the second round, according to all opinion polls, Le Pen will lose either to Macron or to Fillon by a wide margin of about 20 points. This is not the close polling of Brexit or Trump. This is a huge margin. Of course, there's a lot of time between now and the elections. First round, April 23rd. Second round, May 7th. So we'll have the full answer in 2 months' time. At the moment, it seems unlikely she'll be elected president, but if she does, it could be the beginning of the end of the Euro. Well, she might not keep her promises, but anyway, there is talk. Yeah. Let's go back to what I've prepared for you. And our next segment is the ECB Preview. Here's Mario Draghi, president of the ECB. He holds the key to the next moves in euro dollar. He likes to hit the euro when he can. So a bit of background. This is an important meeting. The European Central Bank, based in Frankfurt, holds 8 meetings per year, but 4 meetings include new forecasts. This is one of those meetings, the March meeting. Same goes for June, September, and December. The ECB has one mandate, a single needle in the compass. That is headline inflation. It should be 2% or a bit lower. It just reached 2%. The ECB should be very, very happy. It's the holy grail of central banking. But core inflation is still stuck at 0.9% for the 3rd or 4th month in a row. Beforehand, it was stuck at 0.8. That means that oil prices mostly are responsible for higher prices. The upcoming change in the ECB's policy, announced already back in December, is that the amount of bond buying QE is about to be reduced from 80 billion euros a month to 60 billion euros a month. Here's a picture of ECB officials with printed money. ECB and inflation. Well, it's all about oil prices. Oil prices pushed inflation lower for quite some time, and the ECB worried about second round effects. And now oil prices rise. Well, at least year over year. Remember that this time last year, at the beginning of last year, oil prices were under $30 a barrel, crude oil. Now they're above $50 a barrel. So year-on-year inflation is naturally higher. Of course, the ECB had anticipated this. They told us that inflation would rise sharply at the beginning of the year. But the Germans are worried. Here's a picture from the early 1920s, from the Weimar Republic, when Germany suffered hyperinflation, but that was also a consequence of World War I. Anyway, of course, some central bankers are worried that rising inflation in oil, other energy prices will reach, of course, other figures, other products. Low interest rates hurt pensioners. We'll hear a question in the press conference tomorrow about German and other pensioners suffering because pension funds invest in safer assets and which have low interest rates. Unofficially, Mario Draghi targets core inflation, even though the official target is headline inflation. I think the ECB, not only Draghi, also most of his colleagues, look at core inflation. So other economic factors to watch out for in the Eurozone: growth picked up 0.4 in Q4, stronger than in Q3. Ongoing growth, quite a few years now of steady growth, and it's beginning to accelerate. Unemployment fell under 10% at 9.6 at the moment. Still a long way to go, still double the rate in the United States. But things are improving, including here in Spain, where the unemployment rate is at 18%, but it was already at 27%. Okay, and business and consumer confidence are up. So if you mentioned earlier that PMIs are a bit stuck or even falling in the United Kingdom, in the Eurozone, they're moving to the upside. And so is consumer confidence, not only business confidence. Forecasts. We have forecasts published by the ECB. Subdued forecasts. Last time in December, the last time the ECB released forecasts, they were part of the ECB's dovishness. In that December meeting, the ECB announced that QE would be extended until the end of 2017, the end of this year, and the program would be reduced, and that now the ECB can buy also very expensive bonds, including those that yield interest rate below its negative deposit rate, below minus 0.40. And part of the dovishness of that meeting was lower forecasts for inflation. So no change in forecast despite rising inflation means further dovishness. That means that the ECB said, we expected this and now we expect inflation to fall back. That means they're not very bullish on inflation. That means they will not change their policy anytime soon. An upgrade to inflation forecasts will lift the euro as well, because if the ECB says, okay, inflation is higher and it's expected to rise not only now, but also later in 2017, also in 2018, that means they will withdraw some of the stimulus. The ECB also releases growth forecasts, but inflation forecasts matter most because the ECB does not target growth, but rather inflation. Let's continue. What's next? That will be the question, and the questions asked by reporters and what markets care about. So the QE program runs through 2017, and probably in September, 3 months before it's expected to end, we will hear from Mario Draghi what's next. If they want to taper it, that means gradually withdraw the stimulus and stop buying bonds, and eventually sometime in the future raising rates, or extending it because the economies need more support. But I don't expect any significant announcements, any leaks, any talk about that before August, and any official announcement before September. So it's too early for taper talks, extensions, bullish, dovish. It's too early. But markets will be wondering, according to the tone. If Draghi is more optimistic, you will assume that the next move will be tapering it. If he'll be more pessimistic, an extension will come into play. But we will not hear anything explicit. Moving on, Mario Draghi, pictured here, he would prefer keeping the euro low. He would prefer, consolidating the gains in export growth. Weak euro helps export growth, and in inflation. Okay, so we have a recovery, we have lower unemployment, we have higher growth, we have higher inflation, but it's a bit fragile. He would like to consolidate that, and he can withstand a bit more of criticism he is under pressure from everybody. Of course, he has a very important role in the Eurozone, so he'll, of course, call for others to do more. But I think he would like a weaker euro. He can withstand further pressure. So my baseline scenario is as you were, no big changes. Ongoing stimulus is needed. No plans at the moment to taper. Too early to talk about that. No change in forecast. That means rising inflation is what we expected, but nothing much. No change to future prospects, and no tapering. I would say that in this scenario, the euro dollar would fall because it's a dovish tone. That means that we are expecting further stimulus, perhaps. But the focus returns to the French elections in a matter of a few days. French elections are held in a long time from now, but they have a big impact. But I would say that this would deal a blow to the euro because ECB would be relatively dovish, but it would not last too long. That's my baseline scenario, most likely scenario. Other scenarios. The optimistic scenario is that we have upgraded forecasts, that the ECB is happy with inflation, and the tapering will be discussed in the next meetings. Plural meetings, not one meeting. That may be the next one, but and in this scenario, which I see as quite unlikely, the euro will jump. I don't see it as likely because we're too far away from the end of the program, and the ECB would like to keep the euro low. A third scenario is the pessimistic scenario, a downgrade of inflation forecasts, worries about political uncertainty, and there is political uncertainty, elections in the Netherlands next week, elections in France, in Germany later in the year, Donald Trump, of course, and worries about reform, sustainability of achievements, very, very pessimistic, and not ruling out extending QE to 2018. Also, I see this as unlikely. In this case, the euro will tank and will remain depressed for quite some time. I see it as unlikely because inflation is rising, so it'll be quite hard for the ECB to say, we ignore all the data we've seen so far, and we expect a big downturn. So also quite unlikely, but we should take this into account, okay? Conclusion, two things to watch out for. The forecasts, inflation forecasts remain the same, upgraded or downgraded, and the tone, optimistic or pessimistic. I would expect Draghi to play his magic. He wants a weaker euro. He'll succeed in getting that, but it'll probably be short-lived, not last too long. Markets have other things on their minds, okay? That's my ECB preview. I see no questions here, so I think we can move to the next segment. This is a preview for the non-farm payrolls released on March 10th. It's the report for February, and we want to see wages. Show me the money. We already had things coming into the event. Some say this is a non-event because Janet Yellen and all the other Fed members basically told us a rate hike is coming. So why do we need the NFP? I don't think it's a non-event. I think it still has implications, but the bar is quite low. Wages matter, okay? What happens in the US economy? The US economy, according to the Fed, is getting closer to full employment. Of course, one may argue too many people are not even looking for a job, well, the economy doesn't feel so good. Of course, Donald Trump was elected. And, well, in any case, at full employment, if we get there, we're not there yet, but we're very close, according to the Fed. At full employment, there is a shortage of employees. So if employers find it hard to find people, they raise salaries to tempt employees to join, okay? So higher salaries should push inflation higher, core inflation, not only oil prices, not only other volatile figures, and this will get the Fed closer. The Fed targets core inflation. And indeed, we've seen an improvement in wages, very, very gradual. But in December, the report released in January, we've seen not only gradual improvement, but a jump, okay? 2.9%, much stronger than around 2%. But back, in the previous report, we saw a downgrade for December back to 2.7 and January 2.5. Nevertheless, 2.5 is still above the average of around 2 that we've seen beforehand, okay? Now, as we know, as we've talked so many times, the bar is very low because the Federal Reserve is about to raise rates. So I would say that 2.3% in year-over-year wages or lower could cast doubts about the Fed raising rates. Okay, that means we would need to see another big fall in wage growth this time. That means month over month, we will see a fall in February, okay? I would say that's unlikely, but we would need that or even lower to cast doubts that the Fed will really raise rates. We are more likely to see, according to market expectations, a solid 2.8. So after we had a strong figure in December, lower figure in January, we'll see a bounce back in February, and now we'll see year over year 2.8. Something I've been thinking about and also written about on Forex Crunch, does the Fed already have the data? Okay, the Federal Reserve, remember this is the NFP released in the second week of March. It's released so late because, well, February is a short month, but the Fed always gets the data in advance. Did they have the data already last week? I'm not sure, maybe. At least now they probably have the data before we do, 2 days before that. So I'm assuming that the Fed already knows that the wage report is not a disaster. Otherwise, they wouldn't have come out with all these statements. Okay, so maybe it's not 2.8, maybe it's lower, but it's good enough. The bar is low anyway. Okay, it's done from payrolls. Let's talk about payrolls. Let's talk about the amount of jobs. Expectations stand on basically more of the same, around the average 185. Last time we had 227. No change expected in expectations. The ISM figures are already out. We do have the ADP today, but it shouldn't make a big difference in expectations. The unemployment rate is important for politics, but not for markets. It's around 4.8, and it changes according to the participation rate, which has been rising. It's a good thing. More people that were discouraged to look for a job are back in the labor force. And U6, what's called the real unemployment rate, is on the rise once again. The trend is lower, but it's a bit rocky. I think the last figure was 9.4%. It matters more in the long term. NFP scenarios, I would say between 2.4 and 2.8, basically within recent ranges. As expected, it's cementing the March rate hike, and markets will continue with forecasting 3 hikes in 2017. In this scenario, I would see the dollar wobble, jump a bit up, jump a bit down, basically cementing the rate hike, which is already priced in. So, of course, we'll have action in markets, but nothing extraordinary. If we have 2.9% or even higher, the magic 3%, I would expect a stronger dollar, not only short-lived, but a more sustained rally in the US dollar, and some speculation about 4 rate hikes this year, maybe March, June, September, and December. If we have 2.3% or lower, we'll have a doubt about this rate hike in a week from now, and the dollar would fall. I would say this is highly unlikely, mostly, well, because the trend has been steady, stable, positive, and maybe the Fed already has the data. Okay, so these are the scenarios for the NFP. Before we move to our currency of the week, pound dollar, a few comments here. Jim, good morning. I think market reaction is not so clear. Let's remember March 2016. Oh, you're talking about the ECB. March 2016, when Draghi expanded QE purchases by a third and pushed rates lower. Nevertheless, euro rallied. Yes, that's a good example when Draghi's magic did not work, when he wasn't Super Mario. Okay, that was indeed quite disappointing for Draghi. Also, in the meeting beforehand, in December 2015, they announced quite a bit, and it failed. Okay, but since then, I think he regained his magic in pushing the euro lower. I think he's learned his lesson. What he said back in March 2016, a year ago, was well, he did quite a lot, but what he said also is that we're done for now, and that's what triggered the counter reaction and the stronger euro. So this time, you say, I think a lack of action, no tapering expansion may push the euro to the upside. I don't think so, because nobody expects at this point the ECB to announce anything new. So it depends more on forecasts and on the tone. Okay, I hope this answers the question. It says, why NFP so late? Well, I think because it would have been otherwise published on March 3rd, early in the month and after a short month of February. I didn't check it in depth, but that makes sense to be the reason. Another question from JM, Yochai, how do you see the euro midterm, let's say June, July? See it closer to parity or back near 110? I see it closer to 110, assuming that we have a French president who is not Marine Le Pen, okay? Then we could see, that uncertainty will be over. We'll begin hearing talk that 2016 was peak populism, and Donald Trump also, I believe, will not provide the stimulus, not push, that it will be lower expectations from the US economy in general, so I see euro-dollar as rising. Parity is hard to achieve. Well, I cannot rule out anything, but assuming we don't have President Le Pen, I think euro-dollar will be closer to 110. If Le Pen is elected, all bets are off, okay? I hope this answers the question. Let's move to our currency of the week, pound dollar. Brexit is coming, it's running through Parliament, and it hurts the pound. So, three factors here. Dollar strength pushes pound dollar lower. Brexit issues and Brexit finally biting, finally hurting the economy. Not something that has been delayed, but unfortunately it's coming. So let's run quickly about US dollar strength. The rate hike is coming in March, bearing a disaster. We talked about that in detail. Trump gave one normal speech. Well, that was so last week. Since then, he had his crazy tweets on Saturday, but it does, when he does provide something more normal, more presidential, it does help the US dollar. And there's a bit of a risk-off touch, which also helps the US dollar. But in the pound dollar segment, I want to focus more on the pound. We have a back and forth between the House of Lords, the unelected lords, including some former prime ministers, including other elderly members. They intervene a bit in the process. So they made some amendments to the Brexit bill, the very simple Brexit bill that passed the House of Commons, and sent it back to the House of Commons. Most probably, House of Commons, the elected members of Parliament, will annul this, but it causes problems because, first of all, it puts some the spotlight on the issue of EU citizens living in the UK. Okay, so many people who don't know about their future, so it's quite worrying. It shows that the government has less power, that it's not fully in control. Okay, so it's a bit worrying for people that thought that Brexit will be a relatively smooth process, or at least, well, remember, Theresa May has an absolute majority in Parliament, but certainly doesn't, it's a bit messy anyway, has a bit less power, and many doubt that the government has any plan, that the previous government led by David Cameron had any plan, and that, well, that's not new, but things look a bit messy regarding Brexit. Okay, and the third issue here is that Brexit begins biting. Okay, retail sales fell in December, the month of shopping, and in January. And we still don't have the official numbers for February, but the British Retail Consortium, BRC, showed that a year-over-year drop in same store, like-for-like stores. Okay, so that's another worrying thing. People are buying more essentials, according to the BRC and according to a Barclay survey. More essentials like food, less non-essentials. Prices are higher because of a weaker pound, and this limits consumption of other goods. So that's a point of worry in the UK economy. What's next for pound dollar? Next week we have the jobs report. Watch out for jobless claims. Last time they were, the methodology was changed, so we had a big drop. But this time we could see these rising, and this could be a source of worry. If they fall, of course, it's good news for the pound. Real wages, are they slowing? Is inflation hurting wages? Maybe nominal wages are the same or, well, continue growing in the same pace. But real wages, are they slowing down? Are they falling? These are the two things to watch out for. But it could also be a good report. So that's, I think, Wednesday next week. And there's a rate decision next week. It's not the most important decision. It's not a super Thursday. There's no quarterly inflation report. But of course, every meeting by the Bank of England, by Mark Carney, is an important meeting. The meeting minutes are released alongside the decision. There's no change expected to interest rates, but it could reveal, the meeting minutes could reveal worries about a weak pound, how it's hurting the economy. So that's another thing to look out for. Conclusion, the pound is under pressure. We're seeing it this week. Of course, not only US dollar strength, Brexit, I believe, is worse than Trump. Okay, it's a much bigger change. So if, and of course, Brexit, Trump is so far, despite the wobbles since the elections in November, it's positive for the US dollar. Anyway, Brexit could begin biting, and we should watch economic data more closely. Less politics, more data regarding the pound. Okay, let's conclude this segment with a look at the charts. Let's zoom out to the daily chart, talk about what we're seeing here. So this is the big picture. Here we are in June 2016, 150. Boom, comes the EU referendum. We traded at a range between around 128 to 135. Then we had the second downfall in the autumn, in the fall. In October, the flash crash sent us below 120, and we had a range here of, 120 to 128 almost. And if we zoom in to recent weeks, this is the daily chart. We're seeing a downfall back from the mid, 124 level, more or less, closer. Now we're closer to 120. Big lines to watch here in pound dollar. 120, 120 is the next line of support, worked as such in January. The next level is the round number of 120, or if you look at the real swing low of early January, it was 1.1985. 1985 symbolically is the year we traded at such low levels. Below 120, it's, again, levels last seen 32 years ago. To the upside, we have 122, 123, and 123.50. Anyway, things are looking a bit worse for the pound. I think that if we fall too much, it could hurt the UK economy because it pushes inflation higher. So the Bank of England could say we're watching out for the falling pound. They will not raise rates, but they might try to talk up the pound. Very different from other economies, from other countries. Okay, that concludes our pound dollar segment. Before we move to previewing next week's events, I see here JM shares a chart of the dollar index. Let's show it, share it with everybody here. So here's the chart just showing, as you write here, JM writes in the comments, I have a two-drive divergence completed. I think the dollar needs to fall this 2017. Technically, in Trump, we know he's a wild card. Yeah, Trump is a wild card. That's an understatement. Anyway, JM asks, how do you think Trump policies will affect the USD over the course of 2017? Do you think he's interested in a weaker dollar to boost exports, or he favors a stronger dollar? His recent comments and the comments of his advisor, Peter Navarro, is that everybody's cheating the United States on trade and devaluing the currencies. Navarro and Trump talked about China, even Japan and Germany, okay? So I believe they want a weaker dollar. If you listen to other officials like Steve Mnuchin, they prefer to continue with the official strong dollar policy, which doesn't mean anything anyway. I think that the US dollar did rise because of expectations for infrastructure spending, lower taxes, and higher inflation and higher interest rates. That will be a consequence of more spending. So far, Congress and Trump, they're all moving very, very slowly. Okay, so I think that within 100 days, but we're already seeing the dollar not rise as strong as possible. So we're seeing how the Federal Reserve has already taken back control of impacting the US dollar. So regarding Trump, his impact on the dollar, I think his impact could be negative. A lot more depends on the Fed. the Fed is maybe even sneaking in a rate hike right now, in a week from now, but then they could slow down if the US economy doesn't grow strong enough. So Trump favors the weaker dollar. Trump so far is not boosting the economy. I believe Trump is a negative factor for the economy. The Fed looks at the economy, currently pushing the dollar higher with the rate hike, but later on they'll react to the data and they might slow down rate hikes. So I'm not so bullish on the dollar, to put it mildly, but if the economy improves, the Fed raises rates further, and Trump surprises by fulfilling his promises, then of course we'll have a stronger dollar. But again, I think he favors a weaker one. I hope this answers the question. Thank you for the chart. Yeah, let's preview next week. This is a preview for the week of March 13th to March 17th. We'll have, of course, echoes from the NFP and the ECB. There's a time shift in the US and Canada that means that US figures will be released 1 hour earlier, and I mean closer to European figures. Nothing much is expected on Monday. On Tuesday, we have Chinese industrial output, German business sentiment, always interesting, and PPI, producer price index in the UK, warm up for the CPI. Wednesday is the really important day on the calendar next week. UK jobs report that we mentioned. Watch out for jobless claims and wages. Inflation figures from the UK, top tier figure. Retail sales, even more important than inflation, but everything is overshadowed by the Federal Reserve. Barring any disaster in the NFP, the Federal Reserve will raise rates for the third time in the cycle. It's an important rate decision. They will also produce new forecasts for inflation, employment, and growth. And Janet Yellen, the Fed chair, will hold a press conference. We'll preview that next week. It will be a live coverage, of course, and we talked about it a lot, but that's the plan. If they'll be more optimistic, if it'll be a hawkish hike, the dollar will rise. If it'll be what's called a dovish hike, then the dollar could fall. But just raising rates and not changing forecasts, that's basically priced in, and I don't expect a long-term impact from this event. We already had quite a significant impact from raising expectations, okay? On Wednesday, we also have GDP in New Zealand. Moving forward, Thursday, also busy day, jobs report in Australia. 3 rate decisions that are not the Federal Reserve. We have Japan, not expected to rock the boat, but at least dollar yen will move not only by the Fed, but also due to the Bank of Japan for a change. Swiss rate decision held only once per quarter. No changes expected in policy. They'll stress that they want to continue intervening to weaken the franc to support inflation and to push exports. And nobody will label them as currency manipulators because, well, of their bank accounts. Eurozone inflation, these are final figures, so less important, especially after the ECB. Rate decision in the UK, no changes expected. I expect them to express worries about the weak pound. That's the meeting minutes. And we have housing data in the United States, housing starts, building permits, and the Philly Fed figure and jobless claims. Everything comes after the Fed. So Thursday will be, for the US dollar, more about a second reaction to the Fed than the data. And on Friday, maybe we'll have a waning impact of the Fed because we have industrial output and, more importantly, consumer confidence. That's a quiet end to a very, very busy week. The busiest, the most important event, of course, is the Fed decision on Wednesday evening here in Europe. Okay, so that's the preview for the week of March 13th to March 17th. Well, quite a long show today, quite a busy show. Time to wrap it up. So this is the wrap up for the live market open for International Women's Day, March 8th, 2017. The big movers in the market, well, main Federal Reserve officials that spoke last week, they told us basically more than heavy hints that they'll raise rates that will come on March 15th. The last figure that will confirm it is the non-farm payrolls report on Friday, released late this month on March 10th. Wages are more important than Then the jobs number, I believe that anything between 2.4 to 2.8 is priced in and will cement the rate hike. 2.3 or lower is needed to cast doubts about the rate hike. 2.9 or 3% or even higher will be a big boost for the dollar. French elections move the euro. I will mention in this wrap-up that there's a daily poll by Opinionway released every day at 11 GMT. But at least this week, the ECB is a bit more important. Important event, ECB meeting. New forecasts are released, no changes expected. An optimistic Draghi will push the euro higher, a pessimistic will push lower. I expect him to try to push the euro lower by saying that more stimulus is needed and not raising forecasts. But he also has to acknowledge reality, of course, that things are improving. Any negative impact on the euro, I believe, will be short-lived and will return to politics. Other things to mention in this wrap-up that we didn't talk about. Well, most US figures are okay at the moment. Canada looks okay. Australia looks okay. The UK doesn't look that okay. There are some signs of worry. Let's quickly look at the charts in this wrap-up. So attention towards the big events of this week, especially for euro-dollar. So euro-dollar is a bit lower, but within the range. Levels to watch: 105.20 to 105.90. Pound-dollar at 121.70 at the moment, moving lower. There's a clear trend here. Support 121.20, resistance 122. Dollar-yen just under 114. 114 weak resistance, followed by 114.75. Support at 113. Dollar-CAD at 134.26. Resistance 134.40. Support 133.80. Aussie dollar lower within clear range, 75.40 to 76.10. And the Kiwi dollar moving lower, clear trend here, 69.50, support 69.40, and further 68.80, and resistance 70.40. No big changes during the show, but some currencies are moving in a clear direction, like the pound and the Kiwi to the downside, while some currencies like the euro and the yen and the Aussie are a bit more stable. Okay, so almost a full hour. Thank you very much, everybody, for coming. An important week. Thank you very much for the great questions and comments. I hope I managed to provide some answers to your questions. I wish everybody a safe and successful day and week in markets. Join the live coverage of the European Central Bank and the non-farm payrolls on Forex Crunch and, well, sorry, on FX Street. I will be joining the ECB coverage, and that's it. And see you soon. So that's it for today. Thank you and bye-bye. Thanks, Roman, and everybody.